Greetings, Tony Virtue here, and welcome to our Christmas newsletter. The year went again very, very quickly. Look, in general, an improvement over the world. I think it's been a long, hard struggle to recover from the GFC. There's been very, very low interest rates around the world. That's not sustainable. And the next thing you should expect is that particularly the Americans will stop buying back their bonds, what's known as the QE program, and that interest rates will need to rise to more normal levels. While that can be a little bit destabilising as we go through that, it's actually a positive step. We can't have a environment where interest rates are artificially low indefinitely. If you can't give money away for people to invest, then really that's a bad sign. So look for a more normal market over the next year or two. I think to some extent the equity markets have already taken this into consideration, and we're just going through a bit of a bumpy ride in December. Not a great month for equities, in part because there's an expectation that there's going to be some higher interest rates in the future, which will mean, in theory, companies will pay more for their borrowings, which will reduce profits. But longer term, it's actually not a bad thing to see. It's a sign of confidence in the markets there. There have been quite a few new capital raisings in Australia over the last couple of weeks. Not particularly exciting, but Channel 9, Dick Smith, a number of the real estate trusts have listed, generally only at par or below par, so we haven't got particularly involved with that. Quite a big pipeline in the new year. We do get allocations to quite a lot of these shares, so where appropriate we'll make you aware of those, but in general they're pretty fully priced at the moment. The newsletter shows some graphs from the Sydney Morning Herald, which just gives a bit of an overview of how the year played out. So, as you can see, interest rates still at 55-year lows. That has meant that people who've been renting have been able to purchase properties, and in general the arbitrage between renting and mortgage is very, very close at the moment. So again, for those of you thinking about that, now is a good time to try and get into the property market before it gets too expensive. We are seeing quite a few cranes coming out of Sydney eventually here now, so quite a few developments that will complete in the next 2 to 3 years, and quite a good take up there on off the plan sales there. So some signs of steady optimism around the markets there. The share market as a whole, though, is still below 30-year high, 30% below its previous highs, so probably about fair value at the moment, with an expectation that markets will be fairly careful over the next few months for the interest rate movements I spoke about. Probably more important is the change in the mix of clients. So you're seeing people like Fairfax, Qantas struggling. You're seeing companies like Seek, realestate.com, carsales.com doing quite well. So there is a change in the market mix. You're seeing that globally with companies like Google, Apple doing extremely well. So your investment managers will adjust their portfolios to reflect that, and we need to be innovative and competitive in what we're doing. We are a very high cost economy, and we will need to continually innovate to be competitive in what we're doing there. So look, that's enough for the year. It's been a long year, but a good year. We do invite you to look at our website, to log in personally to our online services. It is a great way of communicating 24/7. We are very, very committed to that in the future, to make things as easy as possible for you to communicate with us. We'll be having a bit of a skeleton staff over the Christmas New Year break, but we'll be back with a bang in the new year. So thank you for your work again this year, and we look forward to being of service in the new year. Happy Christmas.